We're joined now by a professor from the London Business School, Rishaad. Now, Rishaad, you've said in the past that that certain trades, so-called naked swaps, should be banned. Walk us through what they are and why.
The credit default swap market originally began quite sensibly as a way of hedging risk. If you bought a bond, you could insure against the failure of the issuer. So
every hedging transaction had to be met with somebody, an investor, at the end of it.
Underlying bond. And then it morphed into a market which is very much dominated by speculative activity, in which you buy and sell CDS without having any connection with an underlying bond. No insurable interest, as we would say.
Or as Angela Merkel would say, taking out insurance and burning your house down.
Well, that's one of the dangers of trading when you have no insurable interest. Buying a life insurance policy, I could buy a life insurance policy on your life, and then we're walking down the street and I happen to stumble and push you in the path of a bus.
That'd be rather unfortunate, wouldn't it?
Well, it's not my problem, it's yours.
There would be a cop there to take you on, though, wouldn't there? There could be an investigation, a criminal investigation. So that's what we need is regulation, regulating this market rather than banning it, surely.
The difficulty with regulation, with investigations and so forth, is very hard to get open information. It's hard to get information about manipulation in markets and so forth. No, the right solution here, with the degree of systemic risk that these instruments posed, is simply to say, whatever benefits, and I think they're very limited, that they might have, let us do away with them.
My guest yesterday was Professor Murad Chowdhury, and he was saying that you either have a free market, one wants a liquid free market, or, with all the social good which comes with it, and the downside as well, saying that you just can't cherry pick. That's what he's saying, they cherry pick the good bits. How do you respond to that?
It's a specious argument.
Here we
know we have an instrument, a particular financial instrument, that is demonstrably dangerous. It creates long chains of risk which are vulnerable to the failure of any individual trader or a market participant in that chain. And these instruments, in effect, permit the creation of vicious spirals in which the CDS price interacts with the bond price, the market price, and you can have a downward spiral.
But would you acknowledge, though, that credit default swap does play a valuable, part in hedging at the end of the day?
In hedging against insurable risk, if I hold the bond. Yes, absolutely. As I say, that's how it started off. But this is not the way the market has primarily been functioning for several years now. It's not just, not just a professor of economics who's telling you this. George Soros will tell you this. Paul Volcker will tell you this. Byron Scholes, professor of economics, but the Black-Scholes derivatives man, he'll tell you the same thing.
Okay, but it's not just such an instrument, such as a derivative. I mean, we saw the damage just pure cash did in bringing and forcing Britain out of the exchange rate mechanism in the early 1990s.
No, that's a totally different story. These instruments are quite different from playing around in the foreign exchange markets, it's not the same thing. It's not analogous to short selling because, again, the CDS price affects the market funding availabilities for the underlying name. That's the issue.
All right,
and that's the cause of the systemic. One of the causes of the systemic risk.
Rishaad, just last question. How does a sovereign credit default swap, trading affect a country's cost of borrowing, and is there proof that it affects it?
Well, you can never, in fact, the effort to establish chains of price discovery in this market is very, very difficult. And it's partly because you don't know what's leading what. Is the bond price leading the CDS price, the CDS price leading the bond price, and what sort of influences is the CDS price responding to? So can we prove that any individual name is endangered by this market? I think there are some cases in which we can. The Greek case may be one.
Rishaad, thank you so much for joining us. Rishaad from the London Business School.